has literally no ability to impact real inflation. And when I say real inflation, I mean supply side, I mean exogenous events, I mean all of the prices that have either risen or stayed the same or just moved completely independent of the fact that the Fed has raised rates and kept them at these rates for so long. So the Fed has had an inability to understand its capacity to actually impact the real inflation that people and companies and actually governments feel every day around the world. And in fact, they have made the cost of carrying debt, which is enormous and a whole completely separate issue, so exorbitant that the government and people can't even pay for things they need to do to grow the economy or to grow their own personal financial situations. The biggest thing, therefore, is yes, but the Fed needs to understand its boundaries and not continue to pretend that it's like inflation Superman. I say Superman meaning Jerome Powell, in the absence of the ability to impact prices. What's happening with credit card debt, with the outstanding business loans that are out there, with these commercial spaces that aren't basically producing income, all of this is in the same ecosystem. And so what happens is it doesn't take all of them to happen at once for them to be contingent on each other. So people, yes, are continuing to push credit card debt past the limits of comfortability. And part of that is because, yes, there is that plane ticket to buy around the corner. We do have summer coming up. We are going to see probably record airline travel. It was creeping up last year post-COVID, and we'll probably all the airlines are expecting it to, based on their bookings, be at records this year. All of this costs money. And yes, there's a level at which, so the wealthiest echelon of society has enough cash or liquidity to continue to pay its debts potentially, but there's also a lot of pushing the can down the road here with debt. And it's the same thing with national debt at almost $35 trillion. There's a lot of pushing the can down the road. So when does that break? Not necessarily all at once, but what happens is any of those pieces that start to go. And we are starting to see delinquencies creep up for credit cards. We are seeing delinquencies and defaults creep up for 1 to 4 family type housing or sort of small apartment buildings, people not being able to pay their rents. We are seeing all of those things incrementally creep up. So this is sort of this, the idea of the frog inside the pot, you're turning up the water a little, it's not noticing it's boiling. We are actually in that phase right now. So it's not necessarily going to look like a massive crash. It can look like a bunch of banks failing, because I still think there's a lot of banks that are not out of the woods yet because of deposits they've lost, commercial and other loans that are on their books that are falling into delinquency or more defaults. And we are going to see more medium or small size bank failures or consolidations. All of this can happen at the same time, and it all indicates a kind of fraying inside and outside of the lines of the economy. It's really not an economic move in any sort of long-term sense. Why? Well, on the face of it, politically, it looks like, all right, we're going to create these additional tariffs, which are, by the way, not too dissimilar from the tariffs that the Trump administration had created. So not to get political, but this is something that is sort of Washington internal with respect to its competition with China. And it's basically saying, look, on these elements, we're going to basically make it more prohibitive to import from you. And therefore, we're basically taking ourselves off as a buyer for some of your materials off the table. And China, of course, has retaliated, as they did a number of years ago when similar sorts of tariffs in anything from the time of steel, aluminum, and so forth, some of the materials as well as some of the finished parts, mid-production parts, were also tariffed. And this is just extending a lot of that. It creates more tensions, obviously, because now China has to basically step up. And it also creates higher prices for the very people and companies that are supposedly being helped by these tariffs. For example, and we saw this last time, we'll see it again with steel, very commonly used material. When there is a tariff on certain imports, it impacts the entire market. We are in a global codependent economic system. When you raise tariffs, it actually increases prices. So it has the opposite impact from what it might have done decades ago, when it actually helped to work in terms of reshaping how trading partners sort of worked with each other. This is a situation where we actually are a major trading partner of China. They are a major trading partner of us, and increasing these tariffs will increase costs on the actual EV parts, on the battery parts, and in particular, so the critical elements, which that part, I think the U.S. is starting to realize that it needs to move outside of its China supply chain with respect to that and open more of the United States, Canada, Australia, South America, and so forth to actually have its sort of initial supplies on that.
Right.
But in general, tariffs in this magnitude are basically more of a political move than a positive move that will have economic benefits benefits for actually either country. Inflation battle is actually just an inflation new normal period. And that's why even when the Fed says, all right, well, it's come down, but it's not come down enough, which is basically what it's been saying the last, year almost, it doesn't have that much meaning, because the reality is we are in, again, a codependent economic system, and there are supply chain disruptions. There are tensions in the Middle East. There are tensions with respect to Russia and Ukraine. Those amplify at any given time oil prices, certain natural resource prices. We have climate situations or higher aridity throughout the world, which is impacting the cost of wheat, the cost of corn, the cost of rice. None of those things can be controlled by the Federal Reserve. And a lot of offshoots of our food and our energy having high prices not being controllable by the Fed. You throw in what we were talking at the beginning of the conversation, where credit card debt, all of that is high, yet people are still taking out their credit cards, particularly in the United States, and buying at these restaurants and buying these plane tickets. That actually amplifies inflation as well, except that the cost of doing that in terms of the cost of carrying that debt becomes higher and higher. So you have debt inflation and debt servicing price inflation. So we are in actually a new period where inflation itself, for so many reasons, cannot be controlled by monetary policy and will only continue to be controlled by a series of geopolitical tensions, actual supply and demand side issues that I think we're just in a period where it's just going to be around. In terms of looking at, or at least publicly, not at the Q&A, what they are doing is internally they are discussing that is a big reason they reduced the tapering policy that they said they were going to keep in place throughout the whole sort of rate higher for longer period in a way, and they reduced that from 60 billion runoff to 25 billion runoff a month. That's one way to say, look, we are seeing some form of a liquidity crisis. In addition, the Fed is operating at a loss, right? It is operating at the first loss that it has been operating at basically in its history. Its loss has been going on since the end of last year, but it's been increasing. And why is that? It's because the Fed operates in conjunction with these big banks. The big banks basically have to remit their excess earnings to the Fed. The Fed remits those excess earnings to the Treasury Department. It's sort of like an inside baseball thing, but they've not been able to do that because the banks haven't actually reported anyway enough of their excess earnings to make that equation positive. So the Fed's operating at a loss. It knows that. It knows that the federal budget's come in at a record again. It knows that record high debt payments don't actually help economic growth on any level, however you measure it. And it doesn't talk about that stuff because it's so focused on inflation and the employment situation. But if these banks actually collapse, if we get another run like we did last March, and we actually had another couple of banks also collapse towards the end of the year, they just didn't pay as much attention to them, we will get a situation where they will move towards more QE, where you're not going to see 25 billion roll off instead of 60 billion of treasuries. You're going to see zero. And then you're going to see a pump up in QE. That's exactly what happened in the wake of the Silicon Valley First Republic signature collapses, but they happened to have occurred at the same time. So it was more obvious that the Fed actually grew its balance sheet for a minute before they started to shrink it again, even as they were in a process of letting bonds roll off from a policy perspective. These are the things they're going to do. We would see more QE. We might see those rate cuts happen a bit more quickly or in one chunk if we did see that happen, if we saw a bunch of banks collapse at the same time. But QE is going to be the first go-to policy, and then I think we would see rate cuts. We've seen that. We've seen evidence of, even when they were in a rate hiking, this is last March, we were in a rate hiking QT monetary policy, and they still increased their balance sheet by $300 billion. I mean, that's nothing in today's $7.4 trillion balance sheet world, but it was going up instead of going down, and that is because those banks all collapsed at the same time, and they did that literally in a couple of days from signature going under. So it's very possible that that's the first tool that they go to. They don't need a policy directive to do that pivot. You got to look at those actions on the liquidity side, on the QT side, shows that there's definitely at least some people within the Fed. I cannot say that it is Jerome Powell. There's no actual evidence of that per se, but there are internal voices that do have concern about it.